Welcome back, everyone, to the news channel. We are going to be talking about ETFs. What are they? Should you invest in them? So an ETF, for those of you who don't know, it's basically like a mutual fund, but instead of just being able to sell or buy at the end of the trading session, you can buy and sell intraday, just like a regular stock. It's basically hiring management to buy a compilation of stocks or a commodity or another security, and you just hire management based on what they decide to buy or what they decide to sell in their portfolio. And what happens is they then issue you shares that you can buy or sell, just like a stock. Now, if overall it does well, the share price will go up. If the holdings in the ETF go down, the share price goes down. That's the way it works. It's that simple. Now, the question is, should you buy them, and which ones should you buy, and which ones should you avoid, or should you avoid all of them completely, or consider ETFs in your portfolio? Well, it really depends what your investment goals are, and of course, how much time you have. So, for example, if you want to be exposed to the S&P 500, which is overall the weighted stock market, it's the most largest benchmark of the largest companies in the United States, most of them in the world for that matter. So they're in this S&P 500, and what happens is an ETF will buy these 500 companies and have a percentage of a certain amount of shares of these companies, and you can see what their holdings are. The disadvantage is that you're going to have to pay a management fee. So there are management fees, and it's going to tell you, you could just search and see what the management fees are. So for example, so as you can see, these are their top 10 holdings. And as you can see, not all of them have an equal percentage of what they hold. So that's something that they decide. So you could look at this, and of course, you can go to their website and you can see all their holdings, everything they have in the S&P 500. But this gives you an idea of what they are holding. So this can be something to possibly consider if you have a small account, because it's going to be real difficult to buy all 500 companies and have a certain weight in each one, as opposed to just buying this outright. I mean, the share price is right now at $450.79. So for a small account, it's possible to buy these shares. Now, you also have to look at their expense ratio. Now, their expense ratio is quite low. It's 0.09%. So that's quite low compared to other ETFs. And this is what they charge annually. Basically, this is taken out of the share price. This is an ETF that buys stocks. Now, there are other types of ETFs. Now, here's one right here that buys precious metals, such as a gold ETF. There's a whole article about it. There's all kinds of risks involved. There's counterparty risk, and there's a lot of other things to be aware of. Like, for example, management proficiency, there's regulatory oversight, there's a situation where bullion can be lost or damaged. Then you have custodian insolvency, you have regulatory oversight, and there's something called gold taxes. That has to be paid also. So this is going to be extracted from the share price. This is going to weigh on the share price, all these expenses. Then you have sub-custodians, right? So that's when it comes to precious metal ETFs. Now, there's something else to be aware of. So that's when you have an ETF that has the physical, they actually own the physical commodity. So now you have another situation where you have ETFs that actually buy futures contracts, all right? So that's something to really be concerned with. You should consider avoiding those. Let's say an example is a oil ETF called the USO, and what they do is they basically buy futures contracts. So what they're going to do is they're going to go into the futures markets, they buy all futures contracts, and then they issue shares based on the performance of those futures contract holdings. So if the price of oil is going up, the share prices that are issued from this oil ETF will increase. When it goes down, the shares will decrease. There was one problem, though, with futures contracts. They expire, and then they have to be rolled over to the next contract. So let me just show you how that works. So here, for example, are the crude oil futures contracts that USO would buy. So here's a contract expiring December 2023. And as you can see, the last price is $75.84. The very next contract that expires in January, as you can see, the price is much higher, $76.08. That's a substantial difference in price. So when they sell the December, because they have to sell it before it expires, or else they're going to have to take physical delivery of it. So they have to sell it. They have to roll that over to the January. You're looking at a 24 cents difference. And this is a large ETF has over $1 billion in assets, so that's a large premium. The difference is very large between those two. They have to pay extra to roll over all their holdings to the next contract. And that means they have to pay a higher price. So they lose the difference between 75.84. Now they have to pay 76.08. Now, of course, usually the prices narrow as they expire. So December is far away from January now, but it's going to be closer as December expires. When the December contract expires, it's going to be closer to January. So that 24 cents is going to be likely more narrow, but not in all cases. So they have no choice but to roll over whatever the difference is. So whatever the spread is wider, that spread is going to be more costly to the fund. And that's also going to have an impact on the share price because it costs them money and the share price will go down as a result of that. Now they have to keep rolling these contracts over and over again. And it starts to really erode on the share prices, especially if the price of oil is going down. So that's not a good thing. So they call this contango. That's what happens here. This contango situation is what happens when they have to constantly roll these contracts over, and it's costing the fund to lose money based on this. And now there's another factor to consider is that the expense ratio on these funds are generally higher. So let's look at the expense ratio for USO. It looks like the expense ratio is 0.60. So that means 0.60 is annual. So that's an annual percentage that's being taken out of the fund to pay the management. So that has to be paid. So if you combine the expense ratio with the contango, this is something you might want to avoid. And considering the fact the overall return on oil has not been good in the long run. So if you're looking to do this as a long-term investment, as you can see, the price of oil long-term has not had a good return. It's been quite bad. Overall, the all-time high in the price of oil is around $147 a barrel. Now it's trading in the mid $70 range. So the price of oil is down around 50%, and that's going back 14 years. So in a situation like this could be a really disastrous investment because as the price goes down, you have to pay the management fees. And in addition to that, all the costs that the fund have to absorb from all the rollovers of those futures contracts, which is called contango. So combined, it can be a really bad investment. And here's something else to be concerned about. This fund in the past has done something called a reverse split. Let me explain what this is. An ordinary split would mean is that if the share price gets to a point, let's say it's $1,000 a share, and therefore certain investors can't buy that many shares because of the price, or let's say they want to invest in options. So it's going to be a detriment to option investors as well. And of course, if they want to get onto the Dow Jones, let's say, if it's a large company, it's a weighted index based on the average. So they have a requirement to keep the share price down. So what they do is a split. However, there's something called a reverse split. And the exact opposite occurs. So let's say you have a $5 stock, and let's say you have 100 shares of that $5 stock. So what happens is in a reverse split, let's say it's a 1-to-5 reverse split. So what is going to happen is rather than the share price be $5, it's going to be $25. And rather than have 100 shares, you're only going to have 20 shares. So you're wondering, okay, so what's so bad about that? You're in the same position. Well, actually not, because what's going to happen is if the performance of the fund that you have is poor and it keeps going down, like for example, in this case, oil, right? It keeps going down and down. The reason why they do reverse splits is because they don't want the share price to go to zero. If it's at $5 and get to 4 to 3 eventually, I mean, it can go to zero. So they have to keep the share price somewhat to a higher level. And the only way to do that is to reduce the shares that you have. So if they keep doing this, I mean, originally you had 100 shares, now you have 20, and now the stock price is now at 25. Well, what if it continues to go down? It goes to 20, it goes to 15, to 10, it keeps going down even after the split. Then they can do another reverse split. If it does another 5-to-1 split, now you'll only have 4 shares. And then they can keep doing it, so on and so on, and eventually you may be left with 0 shares. So in a situation like this, let's say you want to hold this as a very, very long-term investment. As you can see, it's not going to work out that well. Now, if you're just doing this as a trade, let's say you're doing an options trade on this, or you have a stop loss order and it's a short-term type of investment, yes, that's different. then that's something to look at. But for the long term, as I mentioned, when you have the contango and the expense ratio eating away at the share price, as a long-term investment, as you can see, it has not worked out, and it's something you might want to avoid. So this is what you have to be concerned with. You have to look at the actual fund itself. And like I said, if you're good at asset allocation, if you want to have your own stock portfolio, you want to buy individual stocks and have a basket of different stocks based on what they are, the background, the sector, and you have a good performance of doing that, of course, you're going to take that route because you don't have to pay the fees. And of course, you might not like the type of makeup of the fund. Let's say the holdings that they have. You want to have holdings in more companies than others. I mean, for example, let's look at this. This is a consumer staples fund. And you could take a look at their holdings here. And you can see the percentage, the weight of these holdings that they have. So for example, let's say you want to have a higher weight in Hershey's, right? You could see their holdings in Hershey's is less than some other companies here, right? So that's up to them. You don't have control over that. They control the holdings that they have. If you think that you can beat the market, that you could do well by individual holdings, that'll be a much better idea because you don't have to pay management fees, and you can also allocate more funds to certain companies as opposed to others. But of course, this is very difficult. It's time consuming. You have to have an area of expertise to understand what to buy and when to buy it. Now, they do the work for you. And of course, you can look at the overall performance of the fund, see how it does. And if it's doing well over time and you're happy with that past performance, then you can make a decision that might be a good idea just to buy that ETF. These are some ETFs to look at. What I did is I broke down the type of ETFs they have. There are others out there. There are bond ETFs. There are literally thousands of them. The point of what I'm doing here now is to try to break down what to consider and what to avoid, and what to know when you actually invest in ETFs. You have to know what they have, what's under management, how much is weighted in each individual asset that they have in their holdings. Do they have futures contracts? Do they own the physical commodity? And that in itself can be a risk. So these are things to look at. So I would like to know your comments. What do you think about ETFs? Do you currently own ETFs? Please leave your comments. Please subscribe. Please like up this video, and thank you for tuning in.